Good evening. Could everyone please take their seats? Great. Thank you very much. I'm Peter Scaturo, and on behalf of the board of the Foreign Policy Association, I'd like to welcome you all here this evening to this, the association's 91st Financial Services Dinner. We meet, obviously, at a very critical moment. Decisions taken in global capitals in the coming days and months will shape the global landscape for the next decade. Hopefully, these decisions will lay the groundwork for renewed prosperity. An open global economy has long been a major objective of U.S. foreign policy. Today, however, we are witnessing the forces of deglobalization, decoupling, and derailment. Then there is the financial mercantilism. This is the growing pressure on financial institutions to retreat from international expansion and concentrate solely on domestic markets. All of us in this room can play an important role in convincing the public of the importance of keeping markets open so that trade and investment will continue to flow. We are very fortunate to have with us this evening FDIC Chairman Sheila Bair, one of the key decision makers who is working hard to reverse the downward spiral of despair for millions of Americans who are at the risk of having their homes repossessed. We celebrate today as well Canada's most international bank, Scotiabank, and its leader, Rick Waugh. We may be living on the cusp of history and great change, but we know that financial institutions that stick to their knitting are capable of succeeding even in this difficult environment. We are pleased, therefore, to recognize Hudson City Bancorp and its CEO, Ronald Hermance. Our program this evening is as follows. After dinner has been served, Vikram Pandit, CEO of Citigroup, will introduce Chairman Bair and present her with the Foreign Policy Association Medal. Francis Aldridge Sevilla, a former honoree, will introduce and present Ronald Hermance with the Corporate Social Responsibility Award. And Everett Shank, also a former recipient of this award, will introduce and present Rick Waugh with the Corporate Social Responsibility Award. We will then adjourn the evening. Enjoy your dinner.
I am Vikram Pandit, Chief Executive Officer of Citigroup. I was sitting next to Noel Latif. Citi and Foreign Policy Association go back a long time together, and it is my pleasure to be here with you today as a co-chairman of this dinner. This is an important organization with an influential voice in shaping foreign policy discussions, and we at Citi are a global institution with presence in more than 100 countries, and we serve more than 20 million clients. We're proud to be a member of FPA, and we're proud to have a chance to be part of their discussions on global policy. We have an important responsibility to represent our clients' interest in these discussions, and the FPA provides an important venue to achieve that goal. There is no shortage of important decisions to be made. These are uncertain times. In many ways, they are unprecedented times, and they are times that call for strong and principled leadership from our government officials. Each year, the FPA presents its Foreign Policy Medal to a world leader of this caliber. It is a prestigious award. It honors those who demonstrate responsible internationalism and expand awareness of public policy and public policy issues that impact international affairs. Tonight's recipient of Foreign Policy Medal is Sheila Bair, Chairman of the Federal Deposit Insurance Corporation. Sheila has led the FDIC during its most crucial time in history, and she has proven herself as a strong leader by helping to create stability in the financial services system during this crisis. She was a strong advocate for the provision in the federal government's financial rescue bill to provide FDIC insurance limits on deposits and provide FDIC guarantees on funding. I believe these actions were critical to providing additional liquidity to banks and to help depositors feel safe and confident during a volatile moment. Sheila was also one of the first government officials to publicly say that more needed to be done to restructure troubled mortgages, and has long advocated direct assistance to homeowners through loan modifications. Over the last few months, I've heard from a number of families and homeowners that Citi has kept in their homes. And I can tell you that there is a deep sense of gratitude for the policy decisions Sheila has championed. No matter what the final form of the housing fix is, Sheila's early recognition and commitment to the issue has kept hundreds of thousands of families in their homes. For that, she deserves our thanks and praise. The Washington Post has said Sheila is someone who is principled and blunt without being confrontational. And from personal experience, I assure you this is all true. It is also why I have such great respect and admiration for her. And in addition to her work in the government, she has served as a member of several professional and nonprofit organizations during her career, including Women in Housing and Finance and the Center for Responsible Lending. And with an eye to the next generation, she has published 2 financial education books for children, and I've got them here. Isabel's Car Wash, Rock, Brock, and the Saving Shock. Actually, these are pretty good, and I don't think they're only appropriate for children. Sheila's stewardship of the FDIC exemplifies the promise of that institution to maintain the stability and public confidence in our financial system. But it is her personal character, principles, and compassion that epitomize what it means to be a true public servant. Sheila, because of your important contributions and for your dedication to the founding tenets of this organization, we honor you tonight. Ladies and gentlemen, it is with distinct pleasure that I present the 2009 Foreign Policy Medal to FDIC Chairman Sheila Bair. This is fabulous. Wait a minute, wait. This is the right way. Terrific. Thank you very much. I think that's great. That's great.
Okay. Well, I tell you, when you receive an introduction like that, you just want to say thank you and sit down, because it's hard to meet those expectations. Vikram, thank you very much. That was very kind of you. I've had a pleasure to get to know Vikram over the past year or so and work with him in some very unusual circumstances. And I would like to say about Vikram and many of the others CEOs who currently lead the large banking institutions in the United States right now. It's tough now to be the leader of a bank. It's people don't like banks right now. They're unhappy. They're lashing out. And unfortunately, there are a few that have been making some mistakes that have tainted everyone. But I think Vikram, like so many others, really is working so hard with such dedication to his institution to get it through a very, very difficult time. And so I think that should be recognized amidst all the criticism and public scrutiny. I think that the folks who are trying to do the right thing and lead their institutions and get loans restructured and do responsible lending and serve their communities and the economy should get some credit. I took the job at the FDIC in June of 2006, and it was still a very benign economic environment. And I thought my big issues were going to be whether Walmart should have a bank and debating capital standards in the Swiss Alps. But you know, the warning signs were there then, and one of the first things I did 2 weeks after I assumed office, I put a rule out with the full support of my board to raise everybody's premiums. And at that time, pretty much nobody was paying premiums for the deposit insurance. We had a previous statutory framework, which basically, if you're a well-rated banking institution, you didn't have to pay premiums. And we'd gotten authority to start assessing premiums for everyone, and the idea was to start building up the fund during the good times so we could let it go down during bad times. So there were a lot of bankers that were unhappy with us when we did that, and you know, we were hearing, well, you know, gee, we haven't had a bank failure for 2 years. What do you need to raise premiums? And I'm glad we did it. We unfortunately didn't have enough time to build up the funds as high as I would have liked to have seen going into this challenging environment. And in point of fact, on Friday we're going to have to raise them again. I'll warn you all now. But I think it was wise that we did so. At the FDIC, we've tried to be prepared. We've tried to have been ahead of this, and really getting this award, it's really more about the agency and the job I have than me personally, because we have 5,000 wonderful people at the FDIC who have been working nonstop for a very long period now to prepare for this and now to deal with this as we go into an increasingly challenging environment. We had 25 bank failures last year. We've had 14 already this year, and there will be many more. And almost without exception, they have all been smooth, with the exception of IndyMac, where we had an accelerated situation because of some public scrutiny of that institution. We've been able to transfer these institutions to healthier hands virtually simultaneously with the closing. Insured depositors have had, for all institutions, have had uninterrupted access to their funds. And I think as we've gone experience with this and shown people that, yes, there will be some banks that fail, but it's really a non-event for you if your deposits are insured, has really done a lot, I think, to stabilize the banking system. We're going to be announcing our quarterly banking profile for the fourth quarter tomorrow. And I was sitting around with my staff earlier in the week saying, you know, come on, you know, okay, it was a tough quarter. That's no surprise to anyone. But, you know, what can we say that's positive? And we've got to find something that's positive because there's just far too much doom and gloom around. And I think one of the positive things is that deposit growth was robust in the fourth quarter. Insured deposits are stable. They're staying in the banks. They're providing funding for the banks to lend. And that really is a very, very important driver and source of support for our economy right now. I think the success of the FDIC model is one of the reasons why you have over 100 jurisdictions in the international community who have pretty much followed our model of providing robust deposit insurance. You've seen jurisdictions, the UK for one, strengthen their deposit insurance models after they found out the hard way through Northern Rock that a weak deposit insurance system can be quite disastrous when public confidence becomes shaken in the world's banking systems. So I'm very proud of what the job that we've done. I knock on wood to hope that it continues. I think it will. Again, we have been preparing for this for some time. But I really do thank you for this award, but I really thank all the wonderful people at the FDIC who work there and have been working so hard to protect insured depositors. It really is their award. So thank you very much. It's been wonderful joining you tonight. Thank you.
Good evening. My name is Frances Aldridge, Sevilla, Casa, and I was a recipient of last year's Corporate Social Responsibility Award. But tonight it's my great pleasure to introduce Ronald E. Hermans, Jr., who is Chairman, President, and Chief Executive Officer of Hudson City Bancorp, the parent of Hudson City Savings Bank, which is among the top 25 banks and the largest thrift in the country. Now, Mr. Hermans began his banking career in western New York State. He joined Hudson City Savings Bank in 1988 as Senior Executive Vice President and Chief Operating Officer and became the 11th President in the bank's 141-year history in 1997. He was subsequently promoted to Chief Executive Officer in January 2002 and Chairman in January 2005. With Hermance at the helm, Hudson City grew from a quietly kept secret into a real force to be reckoned with. 2 years after being named president, Hermance spearheaded Hudson City's reorganization from a mutual savings bank into a two-tiered holding company with 53% of the then outstanding shares held by Hudson City MHC, a mutual savings bank holding company that was registered with the Federal Reserve. Now, 6 years later, Hudson City marked another major milestone in which the bank raised $3.9 billion in capital upon conversion to full public ownership. To place this achievement in perspective, at that time, this IPO was the largest ever by a U.S. bank and the 7th largest equity offering in history, even larger than Google. Now, at a time when the banking industry is facing an unprecedented level of uncertainty, Hudson City's traditional approach to banking has been applauded by the national media covering Wall Street and Main Street alike. On June 23, 2008, just last year, Investors Business Daily reported, Hudson looks like one of these rare stocks that, thanks to smart management, will skip the subprime pain. On August 14, 2008, the New York Times reported, Hudson City is one of the few bright spots in an industry beset with gloom and doom. And on October 3, 2008, ABC News said, as big banks crumbled and Wall Street threatened to bring down Main Street, there was a little bank that quietly moved forward and watched its status rise. Now, during this period, Hudson City has also kept shareholders very happy. During the past year, in which the Dow declined 34%, the S&P 500 declined 38%, the NASDAQ declined 41%, and the S&L Thrift Index declined 38%, Hudson City's stock increased 6.26%. So it's no wonder that Forbes named Hudson City the best managed bank in America in 2007 and 2008, the first time a bank received this honor 2 years in a row. So tonight, ladies and gentlemen, Mr. Hermance is joined by his wife, Chris, their children, and the senior executives of the bank. Please help me in welcoming Ronald Hermance Jr., Chairman, President, and CEO of Hudson City Bancorp, Inc., one of this year's recipients of the Foreign Policy Association's Corporate Responsibility Award.
And thank you, Francis, for that kind introduction. Earlier tonight, you heard that we are receiving the award for sticking to our own knitting, which we take as a great compliment. I want to thank the Foreign Policy Association, its president and CEO, Noel Latif, and the board of directors for honoring Hudson City with the Corporate Social Responsibility Award. I feel particularly proud to be receiving this award along with Sheila Bair and with Rick Waugh, President and CEO of Scotiabank, both distinguished financial services executives. And Sheila, we're going to take your challenge, and we're going to tell some positive news tonight. In the letter informing us of our selection as one of tonight's recipients, Noel Latif said that Hudson City was being recognized for our commitment to corporate social responsibility by sticking to our knitting. At this time of financial turmoil, I don't think we at Hudson City could receive a greater tribute than to be recognized for sticking to our knitting. For those of you who are curious about our knitting, it's very simple. We execute on a strategy that provides depositors with an above-average return on products that they understand. And we invest their money in first mortgages, which we understand. What makes both of these lines of business profitable is we focus on holding two parts of the banking equation constant. First, we have a strong emphasis on low overhead and thus high productivity. This, as many of you know, is measured in an efficiency ratio, or in its basic form, the question is how many cents in expenses does it take to generate a dollar in revenue? For the top 50 banks in the country, the average is 65 cents to generate a dollar of revenue. At Hudson City, it's 21 cents. This gives us an obvious cost advantage, which we in turn pass on to our customers. As a matter of fact, total operating expenses for 2008 were $195 million, in contrast to the $285 million we paid in federal and state taxes, which exceeded our expenses by $90 million. The second pillar is credit quality. 99% of our loans are first mortgages, and we portfolio them all, which means we don't sell our mortgages to the GSEs. As of the end of 2008, the average loan-to-value on our mortgage loans at the time of origination was 61.9%, thus giving us approximately a 38% equity advantage. The result is that by carefully underwriting each loan, our non-performing loans were 0.74% of assets, an extremely low number by industry standards. But how do all these numbers benefit the three constituencies that we serve: our customers, our shareholders, and our fellow employees? First of all, for our customers. Last year, our balance sheet grew by $10 billion, from $45 billion to $55 billion at year end. $8 billion of the $10 billion in new assets were first mortgages within our market area, which was a record production year for us. 2009 has started out at a pace that will eclipse 2008. Deposits also showed a record growth as we opened 8 new offices to finish at 127 offices in the tri-state area, with plans in 2009 to open more. For our shareholders, those who bought stock in the original offering 10 years ago have a cost basis of $1.56. And they've recouped that cost by receiving a total of $1.83 in dividends during that period of time. Also, since the offering, the stock price has appreciated 550% and has led the S&P 500 financials in appreciation in both years that it has been included in the index, 07 and 08. Each of the 10 years as a public company has produced record earnings, and we have been able to increase our dividend in each of the last 5 quarters. Finally, due to our strong capital position, we did not need to participate in the Troubled Asset Relief Program, being the largest financial institution to turn down TARP. Our decision revolved not only around the fact that we have tangible common equity of 9%, but we also found TARP had restrictions on the ability to share our future success with our shareholders by eliminating our share repurchase program and any additional increase in our dividend. For our fellow employees, who through participation in the Employee Stock Ownership Plan, or the ESOP, are our largest shareholders. Each employee will receive in the month of March their annual distribution of both stock and dividends from the ESOP. The combined distribution will amount to 44% of their pay based on today's closing price. That is in addition to their regular pay. So by sticking to our knitting over the last 10 years with a simple but powerful model, Hudson City has been able to grow to $55 billion in asset, become the largest thrift, the 21st largest bank in the country, and that may change as I speak, and the 8th largest bank by market cap. We often say in shareholder presentations, we run a simple and possibly old-fashioned model, but regardless, it just makes more money every year. On behalf of everyone at Hudson City, thank you again for honoring us tonight, and we wish the Foreign Policy Association continued success in inspiring the American public to learn more about the world. Thank you.
excuse me, Ron. We've got an award here, which we want. So on behalf of the FPA, and after that remarkable story,
Thank you
here
very
is your
much.
award.
Well, thank you so much.
Good evening. My name is Everett Shank. I'm CEO of BNP Paribas North American Corporate Investment Banking Business, a member of the FPA board and its treasurer. It is a great pleasure for me tonight to be able to introduce to you a leader in the international business community and a recipient of the Foreign Policy Association's Corporate Social Responsibility Award, the president and CEO of Scotiabank, Rick Waugh. Scotiabank was founded in 1832 in Atlantic Canada and is North America's 9th largest bank by market capitalization. Rick has led Scotiabank for the last 5 years, during which time it has performed extraordinarily well. It has grown significantly and especially internationally. Most of us appreciate that it is the most international of Canada's banks, and I think represented in 50-some countries. Total assets have grown from $300 billion to in excess of $500 billion. Number of employees has grown from 49,000 to over 69,000, with half of those employees located outside of Canada and more than a third Spanish-speaking. Rick's leadership has been characterized by a focus on managing the bank for the benefit of its stakeholders. For employees, Scotiabank has consistently been recognized as a preferred employer in Canada and Mexico, and has received particular recognition for its advancement of women. For customers, it has earned a reputation for excellent service and high levels of customer satisfaction. For communities, it has a long-standing history of building and supporting its communities around the world, not only through corporate initiatives, but also through high levels of employee participation and volunteerism. Understandably, the last year and a half to 2 years has been a most challenging time. Scotiabank, however, has performed well, being recognized as one of the world's top-performing banks during the worst stretch of the financial crisis. Rick's work in the financial sector extends well beyond his role at Scotiabank. The bank's strength and Rick's expertise led him to a leadership role with the IIF. He's also involved with several other international business and financial organizations, and in addition, a wide range of charitable causes. With all his work, the performance of the bank, and many personal achievements and his efforts towards addressing the challenges facing the global financial sector, he is certainly worthy and very deserving of this year's award. Ladies and gentlemen, please join me in welcoming Rick Waugh for the acceptance.
Oh, great. Thanks, Everett.
Thank you.
Thank you very much. Thank you. Well, thank you very much. It's great to be invited here in New York, and as a banker, it's great to be invited anywhere, quite frankly. Get from here that. So it's getting to be a very strange experience for some of us, but it's great. And a little bit it's coming home too, because I spent 8 or 9 years down here. And found out at dinner, talking, Ron, to your wife, Chris, we were neighbors in Ridgewood, New Jersey. So maybe something in the air up there in Bergen County to give us an idea of how we run our banks. And so it's great to come back and see a lot of old friends here. Great to see the Canadian flag on the table. That's great. Your president was up just last week, and Rudy hit home up in Canada. With all the problems in the world, we all need friends, and I think the relationship between Canada and the United States, which has always been so special, I think is going to get better. And both our leaders said that, and I know talking to ours, very, very felt that very, very much. my comments, and I have a few messages I would like to talk about, and we're in this financial crisis, and someone asked us, well, why don't we talk a little bit about the Canadian model? And so I'm going to do that, although listening to Ron, I'm going to call it the Canadian model and Ron and Hudson's financial model, because there are some very striking similarities. This crisis, as we all know, started in the financial sector, and until we solve the crisis in the financial sector, we're not going to be able to solve all the other situations that have to be worked in the real economies. So everybody is searching for answers, and it's tough. We see what's happening. And though I think it is instructive as we try to find out solutions to see some of the things that do work, whether it be Hudson City or Scotiabank. And so a little bit of what I'd like to talk about, and not too long, is the financial model in Canada. You know, Canada right now is a G7 country. We've been blessed with some great performance. Obviously, we have the natural resources, but the government policy, both the macroeconomic and the monetary policy, has worked. It was only in the 1990s that there was a Wall Street article, journals that look north, and you can see a disaster up there. It's no better than some of the other countries around the world that were suffering in the crises of the 80s and 90s. All that has changed. You know, our debt to GNP is the best of the G7. All the metrics that you see look very good. We have been surpluses up until now, both in the current account and the trade account. And so those numbers are looking very good. Monetary policy, very early on, has targeted inflation, so we've been able to keep that 2% down. So the macroeconomic policies have worked, but so is our regulatory environment. Our regulatory environment, which is really one regulator, it's the Office of the Superintendent of Financial Institutions, we call it OFSI, has worked very well in a set of framework that has worked for us in Canada. And so a little bit is what has worked, and there's any lessons to be learned, because we are so close and we share so many of the cultures and the cultural values. You know, we're an open society, a democracy, but we do have our particularities that have worked. So in the financial sector, why we have been so benefit to get through this? Well, we're diversified. We're in 50 countries, and we're a national banking system, has since we were formed 175 years ago. So we get the benefits of being throughout the whole country and now throughout the whole world. And we've been very diversified. We have 1,000 branches in Canada, but we've, as Everett said, we've 1,000 branches outside of Canada, 600 in Mexico, third largest bank in Peru. We're the oldest bank in the Dominican Republic, 90 years. I just came from Jamaica this morning where we had our annual meeting, 115 years. And so it's great. We've been diversified, and right now those diversified flows help. But another thing in our regulation, which has worked so well with the private sector, that every 5 years our regulation gets reviewed, the Bank Act, we review it. And so in the 80s, they changed the regulation, and one of the defining things that happened to us, and we didn't realize until now how defining, is they allowed us to buy the investment bankers in Canada. So in the late 1980s, we bought our equivalent to your 5 independent investment dealers. And we've had 25 years experience of bringing that very unique culture and that very unique model of an investment banker, traders and that, and we've learned by it. And importantly, our regulator has learned by that. And believe me, it was a long learning curve. So we've had this comprehensive regulation that has taken the dealer and the banking, the traditional banking model, and the management's learned that. And we put it together. And now why is that important? Well, one of the things that revolved out of that, and it's apparent in this crisis, like Ron's bank, we own our assets. Yes, we securitized a bit of them, what they call the originate and distribute, but we did not make it the basis of our model. So right now, we sit, like Ron, with a large part of our assets in good old first residential mortgages, not only in Canada, but in Mexico, around the world. And those assets are on our books. We own them. We're accountable for them. And yes, we use brokers, but we did our homework on the documentation. Even if it were brokered, the broker had to come into the branch, sit down with the lawyer, and we closed in the branch. Not only did we keep the assets, we kept the relationship, the customer. And this is a customer business. Keep it simple. And what a great product to provide your customer with the first mortgage on their home. And then, of course, we sell them the credit card and we sell them the mutual fund and what have you, and it works. But we are accountable to our shareholders, to our depositor, to our regulator for those assets. We own them. We kept the best assets for ourselves and for our shareholders and didn't sell them to the market. And so today we have that benefit. It's on our books. We don't even have to go out and replace them. We're looking for more business, we're lending, but we have that asset. Gives us a great strength in this market, and I think it's something that as we try to figure out how this next world is going to unfold and that, it's something to consider. And that gets us into the other thing, governance. Corporate governance. And that means a lot of things. It means having your risk management accountable to the assets you have. It's a lot of what we call checks and balances. Internally in the bank, everything is a second set of eyes. So we have a great internal audit. We have great risk managers. And we got great customers in the branch. But it's checks and balances. Because we are dealing in money. And a trader or even a lender can in hours commit the bank to disastrous results. So we learned that over many years. It's part of what we call our risk culture. It's a culture of accountability. And it goes right up to our board. And it struck me as I was thinking about all these things. I'm on this International Institute of Finance, and I co-chaired over the last year and a half, almost 2 years now, where we've come up with 150 recommendations on market best practices. And this was risk managers from all over the world and the private sector. We got together and came up with some very interesting things, and we're now in the process of getting all the banks in the world to go through a self-assessment. We've got to improve ourselves. We know the regulators are trying hard. We know the politicians are trying, again, bankers, CEOs. We have to get our own act in order as an industry. And as I was doing this, I came across my own bank and the other Canadian banks and was struck how our issue of governance has worked up and right to the board. So one of the striking differences, and with due respect to Ron, when I took over as CEO, that was back in 2003, I took over as president and CEO, but not as chairman. We have an independent chairman. And I think that's something we all have to consider. You can be a great chairman, CEO, and president, no doubt about it, and there are many, many other. But in this world, we have to have that, I think, and it's worked so very well, all the Canadian banks have independent, non-executive chairman. We have a great one. And he's there with his independence. He chairs the compensation committee, which has been so very important with some of the problems we have. And he's also there for good advice, as the whole board. So there's these things of the attitude of governance that I think did get carried away. And we learned through it because we had a culture of living with investment dealers and incentive pays. And we had some great traders. We had some great bond traders and stock traders, and we have great investment bankers. And yes, we might have lost a few to Wall Street, but the ones we kept over those years are part of the family, and that's so very important. So we're very proud of that model, and I think that model has to be looked at and perhaps has to be considered. So again, we're going into this environment. The absolutes has to be that we have to get this stabilized. President Obama was right last night. We've got to stabilize the financial sector. Compensation, obviously. Incentives got carried away. Very important. Our incentives in our bank, for 5 years now, my cash as a CEO, because everything's public, has been 10% of my compensation for the last 5 years. We have these look-backs. We have these look-forwards and what have you. And so my interests are totally aligned to our shareholders. It's risk-based adjusted, and it's all throughout our organizations, our risk managers and what have you, and we have it. Compensation, incentives, does determine behavior. and it needs some checks and balances. It needs to be aligned to the midterm and the long term. The one thing I also have learned, there are no silver bullets. And so unfortunately we have politicians now who are looking for silver bullets. Cut the compensation, control the salaries, do this and do that. One thing we've learned is principles are important. Rules have not kept us out of crisis. Sarbanes-Oxley was largely to prevent the Enron situation, the fraud, the conduits, the off-balance sheet financing, and the rules have been horrendous. And the rules have not helped us. But the principles do. And principle-based regulation and an organization based on principles and values, that's your best insurance and the accountability that that comes with. So thank you very much for this honor. We certainly in Scotiabank believe very much in corporate social responsibility. As it was said, we manage for the stakeholders. We truly believe that if you compromise one of your stakeholders to their detriment to the benefit of others, your organization is not going to win. You have to first manage for your customers. They're the ones that give us sustainable revenue. And obviously your employees have to think you're a great place to work. Always have to. Community. We all live and work in a community. And if you don't give back to that, if you don't perceive you give back to that, you're not going to win. And obviously one of the factors that is affecting so many of the Americans right now is bankers are not perceived to having given back into the community. You have to do that. If you look after those three stakeholders, I guarantee you the fourth stakeholder will be looked after, and that's the shareholder. This year, with all the troubles, Oliver Wyman ranked us the top 10 in the world on a risk-adjusted basis for total shareholder return. Now, I wish it was because we were 20% ahead, but it did rank us very, very high. And the principle was simple. Manage for your stakeholders. Remain accountable. Know that the products are simple, and we own the products. We own them by reputation, and we own them by the amount of capital we keep. Our capital is not quite as strong as yours, Ron, but it's about 9.5%, and it's very strong. In the last 3 months, the Canadian banks have raised $10 billion of new capital. Not $1 from the government, all from shareholders and the markets. And so again, in this terrible time, we have had access because again, I think we paid attention to these principles that we just mentioned. So thank you very much for the honor. It's been a very interesting night, and we'll see what the next little while brings. From my perspective, these crises do end. And the things that we're seeing, what the governments have done, wherever it is, in the many, many countries that we do, it is starting to take form. And I think it will happen. We have to solve the crisis. It will be solved. Thank you very much.
Can't forget that. President Obama arrives at the White House with an extremely ambitious agenda. But with the global economy in the midst of brutal financial deleveraging, in which the world is seeing virtually all asset class values decline, he and his colleagues on the global stage certainly have their work cut out for them. The Foreign Policy Association, at its very core, serves as a catalyst for developing awareness, understanding of, and providing informed opinions on the issues most affecting the global landscape. We hope tonight's agenda fulfilled that mission. We thank you for your time. We thank you for your support. Have a great night.